that rates could go higher, get there faster, and stay there longer than anticipated.
All right. The Fed remains committed to returning inflation to its 2% target, as Jerome Powell points to interest rates likely higher than previously anticipated. So where does this leave Powell and his credibility and the path forward for rate hike?
I think at the moment there are two big issues, two macro issues that are driving markets. One is what will happen to inflation over the next year, the next 2 years, and what the economy will do.
Jerome Powell delivered a hawkish message at the Senate Banking Committee. Last Tuesday, he highlighted that US interest rates will likely peak at a higher level than previously anticipated, due to economic data that came in stronger than recent trends suggested. What does that mean? Will the Fed raise rates higher than the 5.1% implied by its last official forecasts in December? Will dreams of a soft landing and painless disinflation become more distant? In this video, Lyn Alden has shared her viewpoint on Powell's latest testimony regarding interest rates and inflation. Stay tuned until the end of the video for more updates. And of course, don't forget to subscribe to Wealthy Value for more of the latest updates on the economy, crypto, and market trends. You can also hit that bell icon to never miss any video. Let's get into it.
One thing I like to highlight is that it's very different than 2008. 2008, banks were at risk due to basically deflationary collapse. There's way more claims than there were base money. And so it's a risk of all falling apart. Now, instead, I think the key risk is longer term inflation. Doesn't mean you can't temporarily get the inflation rate down, but it means that as long as these forces exist, the inflation rate's bias is up. And so unless it's actively being held down, it's ready to kind of keep popping up or kind of keep being a problem. And one way to think about it is kind of like how everything's a nested ledger, right? So we have accounts at banks, they have accounts at central banks, and central banks back up their assets with like government bonds. Bailouts kind of happen upward as well. So for example, when in the 90s, you had long-term capital management, a big giant levered hedge fund that blew up. The Fed had it bailed out. That kind of contributed to the dot-com bubble happening. That all blew up. Then they cut interest rates, and then we had this big housing bubble. And when that kind of finally struck, basically the private sector was totally out of ammo. The whole thing, the whole Ponzi was kind of being like started to get mark to market. They basically pulled private sector leverage onto the public sector balance sheet. And so it all kind of wound up on either the Federal Reserve in some cases, or it wound up just right in government deficits and debt. And what we're seeing now is that when all that is held up to the sovereign level, when you have all the debt goes up very high, the only place to kind of release it from there is onto the currency, right? So you get ongoing currency devaluation, ongoing off and on inflation, and ongoing periods of time where however high or low yields are, they're spending most of the time below the prevailing inflation rate, and therefore savers, bondholders, all these types of holders in the system are essentially getting devalued, and that's kind of just spreading out the losses to anyone who's involved in the currency.
Citing data earlier this year showing that inflation has reversed the deceleration it showed in late 2022, the central bank leader warned of tighter monetary policy ahead to slow a growing economy. The US central bank has raised its benchmark lending rate 8 times since early last year, as the Fed contends with inflation that remains stubbornly above its long-term target of 2%. Despite its forceful moves, the Fed's favored inflation measure, the Personal Consumption Expenditures Price Index, rose slightly to reach an annual rate of 5.4% in January. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy, Powell said. Lyn has also highlighted that the key risk right now is longer-term inflation. Many are wondering, what's going to happen ahead? Why is the Fed willing to raise interest rates so high that they put themselves into negative equity? How will it affect the economy and the market? Let's dive into the next clip to hear Lyn's thoughts on Fed and rate hikes.
This is the first time in modern history.
Wow.
There are some similarities back in, say, the 40s or so, but it's certainly in modern history. This is the first time it happened, and the reason it happened is because we've had like 40 years of declining interest rates. And so there's never a time where they sharply raise interest rates so much that their liabilities are yielding a higher interest rate than their existing assets. Whereas in 2022, they raised interest rates so quickly that the interest that they're paying on their bank reserves and interest rates that they're paying on reverse repos are higher than the average interest rate that they're earning on their treasuries and their mortgage-backed securities. And so the Fed now has an operating loss instead of an operating income. And so they're now basically, if they were a normal bank, they'd be on the verge of insolvency.
Yeah.
But because they're a central bank, they're different. They don't get kind of near-term consequences for having negative equity. And so the way that Federal Reserve accounting works, so right now they're operating a loss. They're no longer sending money to the Treasury because they're not making money to send it to. But then what they're essentially doing is they're eating into their equity. But instead of actually market to market and saying, okay, now we're actually approaching negative equity, they give themselves an asset. It's called basically it's a deferred asset, so that in the future, if they're ever profitable again, they get to pay themselves back first. They get to dig themselves out of this hole before they would resume having to give their excess profits back to the Treasury. And so it's kind of like if you had a business and it starts to go bankrupt, and you say, well, in the future there'll probably be a time when I'm not bankrupt, and so you basically borrow from the future, from my future self to pay back when that happens. That's kind of the thing that the Fed's doing, where they're approaching negative tangible equity, but unlike a normal bank, there's no consequences when they hit zero. There's no consequences immediately, at least when they go negative. And so the main difference is just that they can continue operating.
The US central bank has been hiking rates aggressively and shedding bonds it owes to counter the highest levels of US inflation seen in decades. Disruptions tied to the coronavirus pandemic, coupled with very strong levels of demand, in part driven by government stimulus, have worked together to drive up inflation after many years of price pressures falling persistently short of the Fed's 2% target. Lynn explains how, for the first time in modern history, the Federal Reserve is operating at a loss, and the reason why they're doing so is that they don't get near-timer consequences. The Fed's efforts to temper inflation have taken the benchmark overnight interest rate from near zero levels a year ago to the current 4.5% to 4.75% range. The impact of rate hikes has been there, but not much. The inflation in January 2023 was 6.4% as opposed to 6.5% in December, but it was still down from a peak of 9.1% in June 2022. She further talked about the ramifications in terms of continuing high inflation. Let's get into the next clip to hear more from Lynn.
I think that what's going to drive inflation over the next decade is a combination of uncontrolled fiscal deficits by most of the developed countries, and then two, unlike the past decade, there's not really like a buffer for commodities. So there's no real like commodity oversupply and deflationary commodity markets that can offset some of this. So you have the combination of money creation's happening because deficits are high. Mm-hmm. One way to think of it is that government deficits are a surplus for the private sector. So it's basically it's a way that money kind of pours into the system, and then when you also have tight commodity markets, that makes it so that those increases in money supply do translate into higher consumer prices pretty readily, and that's also true for things like labor shortages. Now you can have periods of time where, if you get a recession, if they cause a big enough contraction in a period of time, you can get a temporary disinflation. You can get a temporary, contraction. You can reduce demand enough to maybe suppress prices for a period of time. But I think those are going to be, the cyclical things, whereas the structural thing is that inflation, unless, of course, they find a way to sharply reduce deficits, which is, at this stage of the crisis, very, very hard to do.
Powell noted on Tuesday that the persistence of high inflation amid broader economic strength could cause the central bank to quicken the pace of future rate rises and go farther with them over time. Is it time for the US to upgrade its fight against inflation? How high could US interest rates rise in 2023? How will it affect the market and the economy? Let me know your thoughts in the comment section below. For more videos on economy, crypto, and market trends, be sure to subscribe to my channel. You can also hit that bell icon to never miss any video. And of course, don't forget to like and share. I'll see you guys in the next video. Adios, and thanks for watching.